So on this consolidation, what we did so far, we look at the consolidation on the chapter 3. We look at the consolidation on the date of that we actually purchased the company, and we purchased 100% of the shares or 100% of the net assets of the company. Second, the chapter 4, what we see is if we don't purchase 100%, what's going to happen? Then we're dealing with the non-controlling interest. So now what we're going to do is we're going to move after the consolidation, after the first year of acquisition, what's going to happen after. Now, one thing that I want you to understand before we continue with this is that on the acquisition date, when we purchase the company, that company comes with the retained earnings. Which retained earnings, we don't have any rights on those retained earnings, even though we have it, right? But those retained earnings will stay in the company. Now the question is, after the consolidation, after we do the consolidation, after we do the purchase of the company, what's going to happen next is the company is going to start working. We're not closing the company. The same company is going to keep working. Once the company is still working, they're going to, if they're generating income, they're going to add to retained earnings. But what we have to have in mind is that the new retained earnings, now we're not going to reset the retained earnings to 0 once we purchase the company. That retained, let's say we have $4,000 in the retained earnings in the company. We purchased the company with 4,000 retained earnings. Now, 1 year after we purchased the company, the company generating income of $6,000, so the retained earnings went to $10,000. And that's how it's going to stay on the company retained earnings. But what we have to realize is only 6,000 of those 10,000 belongs to us, because the 4,000 was at the day of the acquisition, which was before. So what we have to do is, going forward, only we have to, every time when we're doing the consolidation, we have to come back to the day of the acquisition and see how was the retained earnings on that day. And that will be our starting point of the retained earnings, and we're going to see how much is the change from that point going forward. And whatever change is, that's what's belong to us. So let's see how this is going to work. Those are the learning objectives of this chapter. And let's start here. What method we're going to use for accounting for the investment in subsidiary? We can use the cost method or equity method for the parent. So what that means is, this is how the parent is going to report the investment on the parent's books, which has nothing to do with the consolidation. Again, remember this: parent company has his own set of books. Subsidiary has his own set of books. Consolidation doesn't happen neither on the parent's book, neither on the subsidiary books. It happens somewhere else. So both companies going to still report what they have to report. Parent's going to report the investment. Now how the parent's going to report the investment, he's going to use either cost method or equity method. Cost method is going to record income when the investor rights to receive dividend are established. So under the cost method, once the subsidiary declare dividend, cash dividend, then that become income for the parent company. On the equity method, it's a different story. Equity method, the investor or the parent is going to capture the investor shares of any changes in the investment shareholders' equity. So technically, when there's changes in the net income, when the company generates the net income, that net income is going to show us a percentage into our investment, increase the investment. Equity method is going to capture the net effect of any adjustment that have been made to consolidated financial statements as well. So the cost method, what we can see is the simplest one, where the equity method is just a little bit more complicated. Now we have to differentiate between accounting in the internal records and external financial statements. Now the dividend income and equity method income from the subsidiary are usually not taxable. So what that means is you're going to see later, or maybe you already took taxes, right? On the corporate taxes, you already know that the dividend flow from one company to another company,
Yeah.
tax-free,
Yeah.
right? You already know that. Now the consolidated net income will be the same regardless whether the parent using the cost method or equity method. So on that case, on the consolidation, there will be no differences. Again, the method that we parent using for reporting the investment has nothing to do with the consolidation. Now the investment income from subsidiary, when we're doing the consolidation, will be replaced by the subsidiary revenue expenses. So what's going to happen is we know the income is calculation between sales and expenses, and then comes to the income. Now, when we're reporting that under the equity method, that income comes to the investment in the parent. But once we're doing the consolidation, we're not working with the income. We're ignoring the income now. But what we're going to do, we're going to start consolidating line by line, sales, expenses, and naturally we're gonna end up with the same income, but that income is gonna be not as a final number, but as a accumulation from all the different elements on the net income. Now, depletion of the acquisition differential, as you remember, when we do the purchase of the company, first thing that we have is acquisition differential. Again, the acquisition differential comes from the price that consideration that has been paid minus the book assets. And then we can have a acquisition differential, which has nothing to do with the goodwill, not yet. So the depletion, we're going to have that acquisition differential is going to start slowly going down. Why? Because we have change in the fair value versus the book value, and that reducing the acquisition differential. So the depletion acquisition is reflected on consolidated financial statement, not on subsidiary financial statements. Acquisition differential will be amortized. If when we have acquisition differential, we're going to try to amortize it or written down or derecognize on the consolidation. And consolidated retained earnings, we're going to reflect only the parent shares of the combined company retained earnings. So when we're doing the consolidated retained earnings, we're taking only the portion that belongs to the parent, eliminating the very first retained earnings at the date of acquisition. So how are we going to do this? First, we're going to start with the goodwill. We're going to test the goodwill and the other assets for impairment. Now, in 2011, the impairment test for the long-term tangible and intangible assets change in the International Financial Reporting Standards. International Accounting Standard 36 deal with the impairment of assets applies to all the assets unless they're specifically excluded because of the requirements of another standard. And the assets are impaired. So first test that we have to do is to test for impairment. When the impairment exists is when the carrying amount exceed the recoverable amount. Carrying amount can be the net book value, most likely will be net book value, which will be the original cost less the cumulative depreciation for the depreciable assets, or the purchase price for the inventory. So if that carrying amount exceed the recoverable amount, then we have impairment. Now, what's the recoverable amount? The recoverable amount is higher than the fair value less cost of disposal, and value is used. So now we have, you see how many things we have. First, we have carrying amount. I'm going to put this on the Excel spreadsheet, and then I'm going to share my screen so you can see all the things. We have the carrying amount, and we have the recoverable amount. After that, we have a definition for recoverable amount. Definition, because the recoverable amount is the higher. Now we're chasing which one is the higher between those two. Higher one, we have value, fair value less cost of disposal. And then we have fair value of less cost of disposal is the first one that we have to compare. And the next one we have is the value in use. We're chasing which one of those is the highest one. Whichever is the highest, that become a recoverable amount. Make sense?
And what is the recovery amount?
Sorry?
And what is the recovery amount?
Recoverable amount is the higher of the fair value.
And
Fair value less cost of disposal and
also,
value in use. So we have those two. So basically, okay, so now I can share my Excel spreadsheet with you.
can you remember me what is the value in use?
Just a
I'm
second.
confused. Yeah.
So first one, what we're testing? We're testing for the impairment.
Yeah.
We're testing for the impairment. And the impairment asset is impaired. So the asset will be impaired only and only when the carrying amount is more than what we can recover. Make sense? Do you understand this logic? Imagine this. Okay, we are merchandising business, right? We're purchasing a computer. We're purchasing laptop and selling laptops. We purchase laptop for $1,000. That's our carrying amount on the books. But now the recoverable amount, which is higher than the value less cost of disposal, if we have to dispose it, or value in use. So we have to find which one of those is higher.
The recovery amount is the same of disposal, right?
No, less cost of disposal. So basically, fair value less cost of disposal. That will be recoverable amount. Now let's pretend that the fair value, right now the fair value carrying amount of the computer is $1,000.
Yeah.
Right?
Mhm.
Now we're checking the fair value less the cost of disposal. Well, the fair value of the computer right now is $800.
Uh-huh.
It's $800, and if I have to sell it, it's
You have
gonna cost me. I have to pay $50. So the fair value less cost of disposal is gonna be 177.50. Make sense? Are you with me?
No, no, but where
So
did
if I
you
have,
get
so
the,
the fair value, if I'm checking the market value, how
yeah,
much this computer is sell right now. All my competitors selling it for $800.
yeah,
But if I have to sell it,
yeah.
the company, I'm not selling it myself. I'm gonna give it to another company which is gonna charge me $50 to sell it for me.
Ah,
Make
okay.
sense? So that means that I can get 750. I
Because like
cannot.
$50 is kind of it's a fee.
Commission is commission
Yeah.
that I have to pay for the
Uh,
sales commission that I have to pay for my sales engine. Make sense?
yeah.
Okay, so we get one of them. So value in use.
What is the value in use? Ah, there. Okay. $700 50 cent
So the
50.
value in use is how much worth the assets or property based on the benefit generating of the current owner.
Mhm.
This is the definition of the value in use. Value in use of the asset is expected future cash flow that the asset in the current condition will produce, discounted by some stuff. So let's say value in use in this case
Yeah.
is $600. Just random amount. In this case, I'm just picking random amount. So now what we have here is we have to chase which one is higher. Make sense? So we're getting the only the higher of those two. And we have first we have fair value less cost to disposal, and then we have second is the value in use. Which one is the highest one?
The fair value.
Fair value. So
Yes,
the fair value in that case, the fair value become
the higher.
my recoverable amount.
Ah.
Make sense? So whatever is higher from those two will become my recoverable amount. This
Okay.
will
And what
be
happened with the difference with the current amount?
so. Let's hold for a second. So here will be the we can put the formula here. Logical formula will be the no, that will be more like a statistical. We're chasing the maximum. Maximum between this number, one number, and number two is that number, and we're getting the maximum. Maximum is 750, right? We come up with the maximum, which one is the maximum between those two numbers. So, is the carrying amount more than the recoverable amount?
Yeah, it is.
Then we have impairment.
Mm.
So what that means is I have asset which cost me $1,000. The maximum I can recover from this asset is $750. Am I impaired of that? Am I gonna lose money here?
Mm-hmm.
Yes. So
Yes.
asset is impaired. Make sense? This is the test of the impairment. If you have to do test of the impairment, asset is impaired when the carrying amount is more than the recoverable amount. Now, if the carrying
Mhm.
amount is less than the recoverable amount, then it's a different story. There is no impairment. So what will be the case that there will be no impairment? For example, if the fair value, the cost of disposal, let's say now it's not 800, let's say now is $1,200. is the fair value less cost of disposal 50. So that now my fair value, the cost of disposal is going to be equal to $1,150, which obviously is more than $600 value in use. Let's say value in use 600, that's not going to change. But now my recoverable amount is more than the carrying amount. So something that cost me 1,000, I can get more than that. And is there impairment? No, there's no impairment.
No, it's not.
Asset is not impaired in this
Okay.
case. Make sense?
Yeah, it makes sense, but I would like to know what happened with the difference.
What's the difference?
Yeah,
Well, so
I
now
mean,
when we
what
have
happened
here,
with the difference?
so now this difference, once I
Yeah.
sell it here, once I sell it, that will be my profit,
Ah, okay, okay, okay.
right?
Yeah.
That's what's
But
happened.
how do you
But in this case,
report that kind of
which one? This one?
assessment? Yeah.
We're not recording it.
It's just
We
okay.
just we testing our asset. Is the asset impaired or not?
Ah, okay, okay.
Right? If
Okay.
the asset is impaired, we have then we have loss of
Mm-hmm,
impairment. If
mm-hmm.
this is the case, now we have to reduce. We have to bring the carrying amount to the recoverable amount.
Okay.
So we're going to show loss of impairment of $250, which is going to go to reduce our income because we're losing $250, right? Something that cost me 1,000,
Yeah.
I can sell it only for 750. Obviously, I'm right here. I'm losing 250. Make sense?
Mm-hmm. Sí. Yeah.
Right. In this case, I'm not losing anything because I can sell it 1,150. So that means that I'm going to make $1,150. So that's okay in this case. So now let's go back to the slides. So this is how we're testing for the impairment. We're chasing the carrying value exceed the recoverable amount, then we asset is impaired. The recoverable amount is higher than the fair value, less cost of disposal, and the value in use. It's possible for the asset not to be impaired at the subsidiary level, but to be impaired on the consolidation level. So that's its possibility. It doesn't happen all the time, but that's possibility. Now, uh, International Accounting Standards has a different requirements for impairment testing for different type of assets, right? We cannot look at and compare the assets in the same way because they're different assets. So we're going to have a different testing. For the property, plant, and equipment, intangible assets with the definite useful life, we have one type of testing. Different require for the intangible assets with the indefinite useful life or not yet available for use, different. And for cash generating units and goodwill, we're gonna have third. So let's see what we're gonna do if we have a property, plant, and equipment. For the property, plant, equipment, and intangible assets with the definite useful life. That means with the limited useful life because we can have a franchise which is only for 25 years. Right? First step is to identify. Remember those steps because the CPA is gonna want you to do this impairment testing step by step. So first thing is the entity assess whether the indicator exists that the asset might be impaired. If the repair judgment, if in impairment any such an indicator exists, then we're moving to step 2 and perform, and we come up with the determination of the recoverable amount. But again, first step is to find where the indicator for the impairment exists. So which are the indicator for the impairment? Now we can, for the indicator of the impairment, we may have external factors or internal factors? Which are the external factors? Asset market value declines significantly. That will be one thing. So imagine this: we have this what will be that machinery in our possession, which we're using for our operation, but the market value declined. Second, significant adverse changes in the technological, market economy, legal environment, and anything like that has happened. So we have this machinery, which let's say we are on the printing business right now, and we have this printing machine, which using the some kind of what will be that black and white only. When technology changed from black and white to color, obviously that machine will be impaired. Significant increase of the market rate of return has happened and will cause a reduction in value in use, or the carrying amount of the net assets of the entity is more than the market capitalization. That will be the external factors that might be considered and that can show that there's impairment. Now, internal factors. Now, first, there's evidence of solvency or physical damage of the asset. So basically, if we're thinking that the asset is not going to be used anymore because for some reason it's like a broken or something like that, there's impairment. There has been significant adverse changes how the asset is used or expected to be used. So if we're planning to shut down the asset and use it for some other things, because of the changes of technology, that will be evidence of impairment on the internal level. The other one will be evidence of happen from the economic performance of the asset, which make the asset worse than expected. Carrying amount of the investment in subsidiary of the separate entity financial statement exceed the carrying amount of the consolidated financial. This is when the impairment can happen on the cannot happen on the subsidiary level, but can happen on the consolidation level. And the dividend from subsidiary exceed the total comprehensive income of the subsidiary. That will be another internal factor for that's going to show us on step 1. So now, once we identify that, yes, there's impairment, there's indicator that there might be impairment. Second thing is to find out the recoverable amount. And the recoverable amount is determined and compared with the assets carrying amount. So once we find the recoverable amount, we're comparing the recoverable amount with the assets carrying amount, and then we're going to have this. If the recoverable amount is higher than the carrying amount, there's no impairment. So we don't have to do anything. If the recoverable amount, however, is less than the carrying amount, then the impairment exists. And then we have to write down the asset to the recoverable amount. That's we're going to have impairment loss shown on the income statement. This is for the property, plant, and equipment and intangible assets with definite life. So now let's see what's going to happen with the intangible life assets with indefinite useful life. Now, if the intangible assets is not subject to amortization, is tested for impairment annually. So that's the first difference. So now, as you can see, those property, plant, and equipment and intangible assets with a definite life, they're subject to amortization. Now, those one here with the indefinite useful life, they are not subject to amortization. So for that reason, we have to test them annually. When certain criteria are met, then the recoverable amount from the preceding period can be used rather than determining the new recoverable amount. And the last item that's left on this list is the cash generating unit and the goodwill. Obviously, goodwill is allocated to the unit by using the following. Total value of the subsidiary is allocated to each cash generating unit if we have a cash generating units. That become a little bit comprehensive with these cash generating units. It's a dry theory here. I'm not going to spend too much on the cash generating unit, and I'm not going to test you on the cash generating unit. What I want you to understand is if we have cash generating units in the subsidiary, different cash generating units, the goodwill will be from each cash generating units. When we adding together, it's going to be equal to the goodwill at the date of the acquisition of the company, or the entire goodwill that we have on the date of acquiring the company. Again, sum of each cash generating goodwill is equal to the total acquisition goodwill of the subsidiary, if we have a cash generating unit in this one. Now, how we gonna do the impairment? The goodwill impairment test is complex and professional judgment is needed. Before goodwill impairment is tested, all the individual assets should be tested for impairment and any losses are recorded. Then the recoverable amount of each cash generating units. That's again, we're going to the cash generating units. Again, not going to test on that one. Now, if the recoverable amount is less than the carrying amount, then obviously we have the impairment. How are we going to allocate that impairment? First, we're going to reduce the carry amount of the goodwill. And then, if there's anything left, we're going to go with the other assets on the pro rata basis. How are we going to do this? Very simple. I'm going to go with the random numbers on the Excel spreadsheet here. And I'm going to show you very quickly how this happens. Imagine this. We have on this cash generating units in the company, or this on subsidiary level, we have property, plant, and equipment, or we have, let's say, we have building, we have machinery, we have equipment, and we have a goodwill. And we have this goodwill. So now the current carrying value of all those things, the carrying amount of all those building, let's say building is 500,000. Our machinery is 250,000. Equipment is 100,000. And the goodwill, let's say, is 90,000. And those are not random numbers. There's nothing scary. I don't want you to hang out on the numbers. The numbers are not that important. The idea is important. So this is the total $940,000. So that's the carrying amount. We're doing the test for the impairment. We're doing everything. We're looking for the entire group of the assets, and we come up with the carrying value and carrying amount is 940, but the recoverable amount from those assets is $830,000. Now let's go with $800,000. That's how much we can recover. That's all. 800,000. The question is, do we have impairment? Obviously, we do have impairment. So,
Yeah.
all right. So now the total assets at this point, once we get the total, once we get the recoverable amount, the recoverable amount on the total assets now is 800,000 in total. That's how much we can get. Nothing more, nothing less. So the question is, do we have impairment? Obviously, we do have impairment. How much is the impairment? Impairment, obviously, is the difference. 940 minus 800. So we have impairment of $140,000. How are we going to allocate that impairment? Now, the textbook says, let's go first with the this example. Let's go with the first scenario will be the recoverable amount is 850,000. That will be the first scenario, and then we're going to go to the next scenario. So the first scenario, no, that's two made up number. Let's get with this one. Let's like this. The first scenario, $870,000. So how are we going to allocate the impairment of 70,000 over those assets? The rule is this: if there's impairment, first goes to everything goes to the goodwill. So let's see, impairment is 70, goodwill is 90. So first we're going to allocate impairment. First we're going to allocate to the goodwill. So now our goodwill will become this one plus that one. Our goodwill going to become 20. Everything else is going to stay the same. Did we allocate the 70,000? Yes, we did. Total we allocating is 70,000. And once we do that, did we bring the carrying amount to the recoverable amount? Yes, we did. Second scenario will be when the impairment exceeding the goodwill. Let's go with the first one. The recoverable amount is $800,000. If the recoverable amount is $800,000, then what we're gonna do? First, we're gonna allocate $140,000. First, we're gonna allocate to the goodwill. So goodwill is gonna take here 90,000 entire amount. Cannot take more than that. And then we're gonna see how much we allocated. So far we allocated 90,000. How much left for the allocation? $50,000. Now the question is, how are we going to allocate those $50,000? First, we're going to see where are the balances at this point. So we're going to have this building minus this one. We're going to have all those balances here. Actually, that will be plus here because that's negative, so let's keep it plus. We're going to have all those here available. So we're going to see how much is our total assets at this point. At this point, our value of the assets is 850. The next thing that we're going to do is we're going to change the percentage of the assets. And we're going to express those as a percentage. So those $500 are as a percentage of the total are 59%. And the rest is like that. This one is obviously 0. Total should be 100%. 100%. So at this point, how much is the remaining impairment that we have to allocate? The remaining impairment is $50,000. So those $50,000 have to be allocated among the remaining assets. Based on what? Based on the percentage. So what we're going to do, this percentage time the amount that we have to allocate. And we're going to see how much is the actual impairment. So that will be as a dollar amount. That's how much this value is going to go down. And we're doing the same calculation for the rest. And now what will be my carrying amount after the recovery? That will be this one minus, in this case, that one. I'm going to get my totals. And my totals should be equal to $800,000. So basically, let's do the test. Is this 50? That's $50,000. Is this 800? $800,000. So my new carrying amount will be that much for my assets. My impairment. So how I'm going to allocate the impairment? $140,000. Impairment will be allocated on the building machinery and goodwill between those four. The building is going to take that much. Machinery is going to take, let's put it as a negative number, negative that much. Machinery is going to take the rest. And the goodwill is going to take equal to 90,000. So my total impairment is exactly $140,000. Make sense?
Yeah.
That's how we're chasing the impairment when we have intangible assets and a goodwill.
Mhm.
Goodwill takes everything, whatever left, if there anything left, is allocated on a prorated basis amongst the other assets to come up with the new carrying amount of those assets. Okay, so once we clear this one, let's see, can we reverse the impairment loss?
Mhm.
Now, impairment loss, it can be reversed, but not on the goodwill.
Okay.
But it can be reversed only to the original amount.
What do you mean by original amount?
So in order to do that, let's go back to the Excel spreadsheet.
Uh-huh.
And this is the where we end up, right? The new carrying amount, that's what we end up. Pay special values. We end up with those values. My total here is $800,000. And those are my assets that I have, correct? Are you guys with me? This is the new carrying amount.
Yeah. Mhm.
Right. Let's see in the next year, what's happened next year is the next year, we determine now the carrying amount is $800,000. Now let's go, the recoverable amount now is become $900,000. Right? $900,000. So in this case, I can reverse my here this is my impairment. Right? I can reverse it. So basically, I can increase my assets with the $100,000. So my new assets should be $900,000. Make sense? So now I can reverse it from 800. I can go back to $900. If I use the proportional method, what's going to happen? That will be this one divided by that one. And let's No, not here. That should be here. This one divided by total
Maybe.
to come up with the proportion.
Mhm.
That will be the same percentage like before. There will be no change in the percentage. And the total percentage is going to be 100%. So if I do that, what's going to happen is let's insert here and push those one on the right and one more and push one in this on the right side. So I have to allocate $100,000. That's how much I have to allocate, because that's the difference between
Mhm.
800 and 900. That's $100,000. How I'm going to allocate it? Obviously using those percentages. It's going to be equal to this percentage time $100,000. And that's how much I have to allocate for each asset. Once I do that, my carrying amount will be this one plus that one, right? And that's the only way I can get this total of $900,000. Now I have $900,000 assets. But the standard says if you have to reverse, if there's a recovery of the impairment, you cannot go over the original amount of the time of the first impairment happened. Make sense? So this asset cannot be more than that amount.
Okay.
So for that reason, you can only eliminate the original impairment loss. You cannot go over that one. Make sense?
Mhm.
So the maximum that we can take here, the maximum is the original loss that you're having. So this percentage here is going to be useless or disregarded, and the only thing that we can recover is, in order to reverse it, is going to be equal to those amounts. And once you put those amounts, what's going to happen here, nothing goes, the goodwill never going to be recover. There's no recovery on the goodwill. So the new amount will be only this one plus the original. So in that, once you do that, our total is going to be end up with maximum will be original amount, which is 850. Even though our recovery, the recoverable amount increased to $100,000, with $100,000, we can go back only to the original scenario where impairment doesn't exist. However, on the goodwill, once the goodwill is impaired, that impairment, we cannot reverse the impairment on the goodwill. Make sense?
Yeah. Yeah.
Okay. Good. Let's go now with this. Let's continue with our slides. So again, impairment losses, if the impairment, reverse of the impairment losses on the assets other than the goodwill can be reversed. Two-step process. First step, identify the assets whether there are any indicator of the impairment loss either decrease or no longer exist. And second, decrease is indicated in the first step. Then the second step, to recover amount to be determined. Once you do, impairment loss is reversed only if there has been a change in the estimate used for determining the assets recoverable, and reversal of impairment loss is reported in the net income. So it goes back to the net income. For the cash generating unit, is used on the prorated data on the assets and that they have. But again, I'm not gonna chase you on the cash generating units, so you don't have to worry about those cash generating units. Disclosure requirements. If we have to do disclosure requirements on the impairment loss, very extensive disclosure requirements That's all I want you to remember this. Now let's go with the consolidation of the 100% owned subsidiary. Now the investment account is replaced by the carrying amount of all the assets that we have until we get the total assets. Then we're getting the total liabilities. And then once we get the total assets and liability, we indirectly having the equity. Dividends received and receivables from subsidiary are recorded in the parent income when the cost method is used, but those dividends has to be eliminated on the consolidation. So that's why it's important to you to understand which method you're using. Is it cost method or either equity method? Because if you're using the equity method, the dividend recorded by the subsidiary, you don't have to do anything because it doesn't go to the income. It goes directly to the investment account. Where in the cost method, that comes as the income. But since we're doing consolidation between the two entities, any income that's coming from one entity to another entity, that's eliminated. So how are we going to do this? And the second thing is that amortization and impairment of the acquisition differential is recorded on consolidated financial statements in order to match the expenses to the revenue generated by the net assets acquired. Example will be the amortization and impairment schedule. So example, inventory, our inventory on the date of the acquisition had fair value $2,000 more than the carrying amount. But the entire inventory was sold on the first year of after we purchased the company. That means the balance of the acquisition differential here will be 0. Second thing is the goodwill on the date of the acquisition. We had 1,000 goodwill. Which year we tested the goodwill at the end of the first year, and we saw that there's impairment of $50. The goodwill go down, so the new goodwill, the carrying amount of the goodwill on the balance sheet at the end of the first year will be $950. So consolidated financial statement, then I prepared. How are we going to do it? Account by account. Starting with the consolidated income statement, then the consolidated statement of retained earnings, and finally consolidated balance sheet. So we're going with the same direction that we're preparing it. First income, second equity, third balance sheet. Consolidated net income and consolidated balance sheets accounts are same regardless whether the parent using the equity or cost method. So for that reason, we don't have to worry. Dividends on the consolidated statement of the retained earnings are the dividend of the parent. And the consolidated retained earnings reflect the cumulative effect of all the adjustments on that time. Now the consolidated financial statements, then we're going to represent the combined portion of the parent and subsidiary all together on one place. Now, in order you to understand this, we have to go and check the information that we have from the textbook. So for that reason, I'm going to try to bring the textbook first and then going over this example. Just give me a second to go to the textbook. And this is chapter 5.
Mhm.
Let me go to the right place on the chapter. Okay, I think I have something here.
What do you mean by?
Okay. Now I have to move to the Excel spreadsheet somewhere and we
Okay.
can start working there. Just give me a second.
Mhm.
Okay, the first one is ready. Let me grab the other one because there's so many information here. We have subsidiary and parent. Let's make it a little bit bigger. Okay, I have something. And now we can start working with this. So you can actually see what's the actual application of those things. So here on the, I can copy this and move on the Excel spreadsheet, and I'm gonna share my screen just in a second. Let me do some adjustments here quickly to fit it on one place. Okay. I think I'm ready. So here we go. Let's start now. So what we have here is we have this parent.
Okay.
This is the balance sheet. Actually, this is the balance sheet. Let me see where is the income statement. Because that's only the balance sheet. So we need some information on the income statement as well before we continue, because we have to consolidate that income statement. Consolidated cash dividend income. Okay, here we go. Dividend sales, dividend income, and everything else. January. Okay. So what happened here is as you can see, the parent cells, what we're doing on the consolidation, we start chasing the parent cells. Parent cells company has 50,000 cells. The subsidiary has 30. 50 plus 30 give you 80. Now cost of sold. Cost of sold, my cost of sold, the dividend income, we're ignoring it because the dividend income came from the subsidiary. Subsidiary declared $2,500 income. That's not going to be consolidated because that's flowing from the subsidiary into the parent. So those are not shown on the consolidation. those are ignored. Now the cost of sales. My cost of sales are 26,500. My subsidiary sales are 14,700. Now on the day of the acquisition, when I purchased it, I had inventory, which inventory had the fair value on the subsidiary. The fair value, the inventory related to the inventory increase was $2,000. But that inventory is no longer in, I already sold that inventory. It's not longer in subsidiary. So for that reason, I have to increase my cost of sales with the $2,000, which coming from the acquisition differential when I purchase the company. So that $2,000 are gone. Now I'm going to have the impairment of the goodwill. I don't have anything. The subsidiary don't have the goodwill, but we have impairment of the goodwill of $50,000, which my goodwill was $1,000 on the day of the acquisition. On the first year, $50,000 impairment. So that impairment is going to come as a decrease of my sales. And the last thing that I left is the miscellaneous expenses, which are miscellaneous 5,200 from mine, 8,000 from subsidiary, 13,200. So consolidated net income in this case is 23,550 between the both companies. That's pretty straightforward. As you can see, there's nothing scary here, nothing hidden. Make sense?
Yes. Yes.
So that's for the income statement. Now let's move to the next one and let's try to prepare the second part, which is the statement of consolidated retained earnings. I'm going to copy it. I'm going to move it back to the Excel spreadsheet here. That should be accommodate my needs. So now, how much was my retained earnings on the at the end of the first year? So we're going to come here. We're going to see how much my retained earnings. As you can see, my retained earnings is 85,000. Can you see it?
Yeah.
Now, from the income statement, we're getting the increase of the retained earnings, 23,550, because that's what's happened in the first year. That's increased our retained earnings. Now, the other company, we're declaring dividend of $6,000. Now that's in the textbook. That's not here on the example. That's on the textbook. The parent actually declared and paid the cash dividend $6,000, which we're going to reduce our retained earnings, and the new retained earnings is 102,550. As you can see, there is nothing scary here at this point, because we're starting with our, again, logically start with the balance on January 1st, adding the income from the current year, which comes from the consolidated income statement now, deducting the dividend that we pay to our shareholders, and we're coming with the final balance on the retained earnings. The last thing that left is the balance sheet. So now on the balance sheet,
The dividends
yes,
of 6,000.
6,000.
Okay, yeah.
Yes, the 6,000. The
It's in the
parent,
balance sheet.
yeah, is on the balance sheet. So the parent, no, it's not. That 6,000 is the retained earnings of subsidiary on the day when we purchase it. That has nothing to do. This is just coincidence. This 6,000 has nothing to do with those 6,000.
Okay.
Those two, they have nothing to do, right? This is the dividend that the parent declare and pay to the parent shareholders. Has nothing to do with the subsidiary, right? So don't mix those two. Yes, they're 6,000. Looks like they're the same number. They're not.
But that information is given to us, right?
That's information is given to you on the actual questions on the textbook.
Okay.
Yes, that's why it's like it will be easy if you can see those one. Let's see if that what exactly is given to you in the question. So what I'm looking is I'm looking here. This is the question from the textbook. This is what we're actually doing. We're doing this question here. This is the question. This is the exhibit 5.2 consolidation. So in this case, the company purchased so first we're starting with the purchase day on the
Yeah.
investment, right? How much they purchase, what they get, what was the acquisition differential on the day of the purchase, $3,000. $2,000 allocated to the inventory because the inventory was fair value was higher than the carrying amount with $2,000, and the goodwill was that much. Now the balance sheet on January 1st of the boat company is here. So now we're showing this investment $9,000, which is the how much we invested, and what would the subsidiary had and what we added. So that's for that inventory. As you can see, the inventory is 34 consolidated, but 34 is coming with because we have 22 our inventory, 10 inventory from the subsidiary, that's 32, plus the 2,000 increase the fair value versus the carrying amount, and we're getting 34,000. 1,000 is the goodwill that we're getting. Liabilities is our liability plus their liability. And the common shares as our common shares and retained earnings only. Those 16,000, there was already in the investment, 16,000, as you can see, investment, that's 19. But once you eliminate the 19, I have 3,000, 3,000 increase with the 2,000 in the inventory, 1,000 in the goodwill. That's how I'm eliminating this investment here with those 16 here plus adding 3 more here. And that's now become 19 to 19, right? And now I'm in balance. So this is on the date of the on the purchase. Consolidated balance sheet prepared for the estimated 16,000 against 19,000, which is again the 16,000 is the equity of the subsidiary, which is replaced by the 19,000 investment and the 3,000 and 1,000 and 3,000 differential, which is 2,000 in inventory and 1,000 the goodwill. Now, in the year 5, company reported net income of 7,300, pay cash dividend 2,500, that's subsidiary. Company P net income for the year was 20,000, indicated dividend, including the dividend 2,500. Using the cost method accounting, company paid, they recorded the dividend, so they're showing the dividend as a cash and dividend income. That's why we're eliminating the dividend income, because they're using the cash method. If they were using the equity method, we won't worry about that one. And then we start doing this. Now the dividend here, as you can see, that dividend is not communicated. It doesn't say anywhere in the question, but should say somewhere that the $6,000 dividend was actually paid from the parent company to the parent shareholders. And the last thing that we have to do once we do the retained earnings, then we have to do the consolidation of the balance sheet. How are we going to do the consolidation of the balance sheet? I'm going to bring it from the slides, and I'm going to show you in the Excel spreadsheet how we're doing that.
Okay.
That's for the assets. So miscellaneous, goodwill, liability. Okay, that's the one. So this is the one here, and the other one from the textbook. I want you to get from the textbook, I want to get information about these assets here, and that's going to help us to come up with consolidations once we get this part. Okay, let's share my screen now with the Excel spreadsheet, and you're going to see on the Excel spreadsheet how everything is done. So now on the Excel spreadsheet, as you can see, first we have miscellaneous assets. Miscellaneous assets from the parent plus the subsidiary give us the total. Then we have the inventory. Now the inventory, my inventory plus the parent inventory. Now on the what's left on the acquisition differential, well, nothing left on the acquisition differential here, right? Remember on the acquisition differential we have $2,000, but those $2,000 was already sold, so we get rid of them and we add it to the cost of goods sold. So there will be no $2,000 related to the increase in the fair value because that inventory has been already sold. We're not carrying that, the subsidiary don't have the inventory, so that will be eliminated here. Now on the goodwill, we're going to keep only 950. Why 950? Because 1,000 was the day on the purchase minus the $50 impairment. So we have 950. Liabilities, we're going to calculate the liability at the end of the first year. 47 plus 1150, we're going to get that one. And the common shares is our common shares only. Now on the retained earnings, we're going to get the retained earnings that we get from our calculation from the consolidated statement, right? It's not that retained earnings, final retained earnings is not going to be equal to the retained earnings on the parent only. It's going to be related to the consolidated retained earnings, right? So that's the things that we have to remember here when you're doing the consolidation. Start with the income statement first. That income on the consolidation is going to drive you the increase of the income on the equity section on the statement of the retained earnings, minus the dividend that has been paid by the parent is going to give you the balance, and that balance automatically is going to flow on the retained earnings on the consolidation. The common shares, if there's no issuing the common shares on the parent, there will be no change in the common shares. Then you consolidating line by line assets, inventory, goodwill from the original goodwill that we have 1,000 minus the impairment 50, and the liability is the same. And that's how we're doing the consolidation of the date of first year of the operation for this entity. Now let's go back to the slides and see now what's happened with the consolidation on the 100%. When the parent uses the cost method of accounting, consolidated net income has to be calculated by converting the equity method net income, since the equity method reflects all the consolidated adjustments. So what's going to happen in this case? Once we're using the cost method, we're getting the company net income under the cost method, which is 20,800. Ways where we can find this 30,000, 20,800. Just a second, I'm sure. Let me copy this one. I'm gonna flip back on the Excel spreadsheet. Yes, so you can see it there. Okay. There we go. Coming, the Excel spreadsheet coming. So here, what we can see is we already know that the parent using the cost method, correct?
Yeah.
So we're chasing the parent net income using the cost method is $20,800,
Mm-hmm.
right? So
Yeah.
$20,800. We're gonna eliminate the dividend that coming from the subsidiary. 2,500 comes from the subsidiary. We're eliminating that one, and we company left with the net income from the own operation, 18,300. Make sense? So
Yeah.
then we're chasing the subsidiary income. Subsidiary income was 7,300. We're adding subsidiary income. Now, is there anything that affect our acquisition differential? Well, there is. What was that? That was the inventory that we have increased with 2,000 that has been sold. So that $2,000 went down to zero, and the 1,000 goodwill instead of 1,000 went down to 950. We can see this one also on the slides. Let me pull that one from the slides and post it here for you so you can make the link.
Mm-hmm.
And that will be here, this one. This is actually the one that I wanted you to see. So from here you can see that the inventory has been sold. So effect is zero. Carrying amount is zero. The goodwill decreased with 50. So the carrying amount is 950. So that gives you the difference of $2,050 in decrease. So those $2,050 increase is right here. So from the subsidiary, basically, because we have this subsidiary, our increase changes of the on our side in our income is only 5,250, right? What we get from subsidiary minus the effect of the acquisition differential that we have from subsidiary, and that's going to give a consolidated net income 23,550, which 23,550 was exactly the income that we come up with when we consolidated the income statement. Make sense?
Yeah.
So that's how you can check yourself. Is this actually make sense? By converting the cost method, by using only the cost method.
Yeah.
Right? At the end of the day, you have to understand the consolidation is simply math. And
Mm-hmm.
once you get the numbers right,
Yeah.
the math always checking. There's nothing, no, it seems like a complicated, but it's nothing scared here. Don't get scared about this consolidation and anything like that. It just sounds like a scary stuff. It's not that scary. Now, we calculated this where we are. Let me see where we are. Oh, we are here. No. This one, we covered this one, we covered this one, we covered this one. Here, that's where we are. Now, if now let's make it difficult. That was when 100% is owned. Now, if it's less than 100% owned, what's going to have? We're going to have this element of the non-controlling interest. So once we're having the element of the non-controlling interest, we have to calculate that non-controlling interest on the, so first we're going to use the implied amount. So basically, in this case, we're purchasing only 80% of the shares of the company for which we pay 15,200. Now, the question is, what if we purchase 100% of the shares? How much we supposed to pay? We're supposed to pay 19,000. So based on the 19,000, 20% doesn't belong to us. So that means $3,200 are related to the non-controlling interest. So once we have this non-controlling interest, then we have to again do the calculation on the company net income using the cost method, less the dividend, and we're going to get the company net income from the own operation. We're going to get the subsidiary income minus the amortization of the purchase price differential, acquisition differential, and we're going to get the number 23,550, which is exactly the same that we're getting. The only thing difference is here we have to see how much of this consolidated income doesn't belong to us or related to the non-controlling interest by simply applying the 20% and calculating the amount of the 20%.
Okay.
And that will be that. Now, if we have to do the consolidated statement, we're still going to do the consolidation the way we did it. But at the end, every time at the end, we're going to have this non-controlling interest showing up.
Non-controlling.
Non-controlling interest is going to be show up at the end. On the income statement, we're going to come up with 23,550. We're going to come up with the shareholders, how much belong to the parent and how much is related to the non-controlling interest. Same thing we're going to do with the no, actually on the statement of the retained earnings, then it's going to be easy because now we're not going to get the 23,550. We're going to get only the income that belongs to the parent, which is 22,500, which is the original minus the non-controlling interest. The 6,000 dividend that the parent paid to the shareholders, 6,000. There's no difference there, and we're going to get the consolidated statement of the retained earnings, and then we have to do the balance sheet. On the balance sheet, everything will be the same. The only difference will be the non-controlling interest. Now, on the non-controlling interest, we're going to have 4,350, which is related to. Now we're going to have this crazy calculation here. We're going to have $10,000, 20% of the 10,000 plus 10,800 plus 950. 950 is related to the goodwill. Now the $10,000 is going to be 10, 11. Let me see where exactly are related to $10,000 on those one. Trying to find out where those $10,000 coming from. Just give me a second and I'll tell you exactly from where they're coming from.
Yeah, it's okay.
Trying to find out where the textbook is that with the 80% only. Yeah, I found it. So where's the 10% only? 80%, and let me see where the $10,000 coming from. Cannot find this D and E from where they're coming from. I find A, I find B, but I cannot find D.
Yeah.
Try to relate it to the textbook and find it. Even in the textbook, they clearly says 10D and 10E.
Mm-hmm.
10,000 D. Non-controlling interest 10,000. 50. I don't think that they're coming from the yeah, actually, yes. That's exactly from where they're coming from. So then those amounts,
Mm-hmm.
where we are, we on the in the Excel spreadsheet, right?
No, we were
On the slides.
right. Yeah.
On the slides. So those 10,000 and 10,800, those
Mm-hmm.
are coming from the original, original 10,000 of the retained earnings, common shares on the subsidiary, and the
Mm-hmm.
retained earning of the subsidiary.
Mm-hmm.
So where we can see those one is right here in the very, very, very beginning of the whole scenario. And the subsidiary started with the subsidiary had 10,000 the very beginning. Subsidiary have common shares of 10,000 and retained earning of 10,800. But since this is related to subsidiary, they don't belong to us. 20% of these common shares of subsidiary don't belong to us. Remember, we owing only 80%. So the 20% from the common shares and 20% of the retained earnings, they don't belong to us.
Okay.
So for that reason, we have to calculate the non-controlling interest on those two items plus the goodwill, 20% of the goodwill, and that's how we come up with this amount of $4,350. So what we're gonna do with the consolidation of the equity and cost method, if the parent using the cost method to record subsidiary, is necessary to calculate the opening consolidated retained earnings the way we did it from the cost method, moving to the equity method. So what we're going to do, we're going to eliminate the dividend first, which we receive from subsidiary. Then we're going to get subsidiary income for the year, minus any amortization of the acquisition differential, if there's any. And that's how we're going to come up with the equity retained earnings under the equity method. Now, if we have to do this under the year when we have a non-controlling interest,
Mm-hmm.
so we're gonna start with the, but that now we're moving to year 6. Now we're moving to year 6. Is this year 6, which is 1 year after the year 5? Now we're moving to year 6. The slides are again, slides are very, very much related to the example of the textbook, and the way the slides are coming is first they getting on the year 5, first year of the end of the first year of the after the acquisition, looking at the 100% owned shares and 80% owned shares, and then moving to the year 6. Where in the textbook they're going with the example, they're going with the 100% year 5 and year 6, and then we're going with the non-controlling interests, not only 80% for the year 5 and year 6. That's why here on the slides they're like a little bit more complicated. So in this case,
Yes.
in
Let's
this
move
case,
on.
it's So what I want you to do when you're trying to understand the whole logic, stay with the textbook. Stay with the textbook because the textbook actually follows the logic year after year, year after year. So in this case, on the consolidation, now as you can see, we have to check what's the retained earnings at year 6 under the cost method. And then we're going to the retained earnings which are generating year 6. Retained earnings of the acquisition. So that's why we're getting the retained earnings of the acquisition. We're getting the increase of the retained earnings that actually belongs to us, minus the any changes of the acquisition differential. And in that case, we're going to see how much belongs to us and how much is the consolidated retained earnings. Actually, this one is here. Actually, this one is actually consolidation. How we getting to 101 and 500. So that will be the same calculation like before, but the company retained earnings at here at the cost method. Let me see if that's in the slides somewhere. Not in the slides, on the textbook. Yes, it's in the textbook, 99,300. So that will be, we're gonna get it right from here. Let me share my screen. From the company, from the parent company, our retained earnings is 99,300, as you can see here. Can you see it?
Unmuted. Yeah, 99, 300. Yes.
300, yes, that's our starting point.
Uh-huh.
Once we get that one, once we get our starting point, come on, share it. 99,300 is our starting point. Then we add in retained earnings from the company, which was 10,800. We eliminating the retained earnings, which was at the time when we purchased the company, only 6,000. So only increase of the acquisition after the acquisition is 4,800. So once we purchase the company generate increase the retained earnings to only 4,800. But out of 4,000 those increase, we already amortize acquisition differential for $2,050. So that means the net increase for us is only 2,750, which 80% only belong to us, which is 2,200. And that added to our retained earnings is going to give us the retained earnings under the equity method, which is 101 and 500, which is exactly that retained earnings. Where was that retained earnings? What we calculated here once we're using the consolidation under the cost method. That's how we're moving from the cost method into the equity method again here. So the next thing will be calculating of the non-controlling interest only. Now from the company, they have the common shares of $10,000. Retained earnings is 7,000. That's the retained earnings from the subsidiary, 7,800. And any remaining acquisition differential, which is related to the acquisition differential. And that's going to give us a new number. Non-controlling interest will be 20% of that number. And we're going to get it. It's getting a little bit complicated here. I guess we have to look at those as in the relationship between the textbook and the slides in order you to get it. So that's why it's important for you to have the textbook when you're going over the slides. So the next thing is calculation of the retained earnings now at the end of the year 6. Now we're moving to from year beginning of the year 6. Now we're moving to the end of the year 6. And again, we're doing calculation with how much is the company retained earning of that point, or of the parent company, how much is the retained earnings, how much is the retained earnings of subsidiary. We're deducting the retained earnings on the purchase date that we purchased the company, and we're going to see how much is the increase since we purchased the company. Then next thing that there will be more on the year 6, there will be more impairment on the goodwill. The goodwill going to go down with another $30 to 870. No, 920, no, to 920. That will reduce the increase since the acquisition, and we're going to get the percentage that belongs to us only, and we're going to get the consolidated retained earnings. If we're using for the non-controlling interest, if you're using the identifiable net asset method, only the parent shares of subsidiary goodwill will be included in the consolidated financial statements.
Only the parents?
Sorry?
Only the parents, you say?
That if you're using the net identifiable method, asset method. If we're using that method, is measured for using the identifier. Only the parent shares of subsidiary goodwill will be included on consolidated financial statements.
Okay.
Then the so the
We
goodwill
were assess the cost method.
the cost method is how we reporting the investment in the parent. That will be cost versus the equity. A net identifiable method versus the what was the other method? Fair value valuation method. No, fair value valuation, fair value. There are net identifiable assets that we talked about last time, and there will be another method. Will be the fair. I think the fair value methods. When we're doing the implied amount for the acquisition, when we're not purchasing 100%. So those are the two methods. So basically, the textbook is under the other method, which is the fair value, rather than the net identifiable assets method. But if this method is used, then we have to calculate it. Only the parent shareholder subsidiary goodwill will be included in the consolidated financial statements. Right? Don't mix those one. Don't mix the how we are reporting the investment on the parent's book versus which method we're using for the calculation for the non-controlling interest.
Non-controlling interest. Okay.
Right? That's a different story.
Well, we were working with the cost method.
Here we're more working with the cost method when it's reported on the investment is reported on the parent's book.
Okay.
And then consolidated to the equity method. But the net identifiable asset method is a method, one of the methods that we can come up with the non-controlling interest.
Okay. It's a little confused. Yeah.
I know. It's getting confusing at this point.
Yeah.
Okay, what else? What else on this one? Intercompany receivable and payable. That will be the interesting thing. When we have the intercompany receivable payables on the consolidated statement, we have to eliminate those ones. If there anything that one company dealing with the other company, we have to eliminate those intercompany receivables and payables, and those not going to appear on the consolidated statement. But next chapter we have to talk more about the intercompany transaction and how exactly those are related on the intercompany receivables payable. What's going to happen if we acquire subsidiary during the year? Then the consolidated statement should include only the subsidiary net income from the date of the acquisition. So that's why it's very important we to determine how much is the retained earnings of the subsidiary on the day of the time of the acquisition, and how much obviously the income is on the time of the acquisition if we acquire subsidiary during the year. Now again, parent can use cost method or equity method to the general ledger for accounting for the investment. Now only the investor's shares of the investee income in dividend amortization acquisition differential are recorded on the investor records if we're using the equity method. And the investment account, we're going to capture all the adjustments since the date of the acquisition. What will be the analysis of the financial statements? Interpretation of financial statement. Return on investment for the parent separate entity financial statements under the equity method should always be equal to the return on investment on the shareholders of the parent company consolidated financial statements. And for the goodwill impairment, again, the only thing that you have to remember is goodwill impairment is when the recoverable amount of the cash unit as a whole exceed the carrying amount of the net assets, and the recoverable amount is greater than the fair value from the selling of the unit today and the value in use in this case. And if the cash generating units, his amount come back, there is no reversal on the impairment that previously has been recorded. That's another thing that I want you to remember. And that's with this chapter. It's very lengthy chapter. I don't think we're gonna do 2 chapters today, unfortunately.
No, I don't think so
Yeah,
because honestly,
because
I cannot
this getting
go
heavy.
over. Yeah, yeah,
This getting heavy. And
yeah,
if I throw you right now another chapter which is also heavy,
yeah. No, no.
you're gonna go crazy,
Yeah, no, no. This
right?
chapter is so heavy. Yeah. To be honest, I think I will need to like read it
Yes,
again
no, I
because
understand. Totally
it's not
understand this.
easy.
No, it's not easy. It's
Yeah.
getting this. So the most difficult chapters in
Yeah.
these textbooks are chapter 5 and chapter 6, right?
Okay. Okay.
So
Yeah. Yeah.
we better have next week again. So
Yeah.
next week to slowly go with the chapter 6. That will be better for you rather than rushing through the chapters just to say, okay, we covered it and okay, you guys deal with it. That's not fair for you.
Mm. The midterm includes
5,
chapter
6.
6.
Midterm include chapter 3, 4, 5, and 6. So for that reason, but listen this, that's why it's important for you to do the assignments related to those 3 chapters, 4
Yeah.
chapters.
Yeah. Yeah. Yeah.
Because the questions that you're going to see on the assignments, those are the questions that's going to come on the midterm exam. For that reason, every time the Excel spreadsheets are already attached to the assignments, what I suggest you to do is, once you see the question, see which Excel spreadsheet relate to that questions. Prepare yourself, use that Excel spreadsheet, use it for solving your problem, and once you solve your problem, save that Excel spreadsheet. Because later on, you can see this, you might find the same question on the midterm. And when you see the same question on the midterm, use the Excel spreadsheet. right? Because you can
Yeah,
transpond
yeah, everything
whatever
is
you get on the Excel spreadsheet, you can transpond the information to the website, and you're going to get the answers correct.
okay. Okay.
Okay.
Okay. Thank you, Professor.
Thank you, guys.
No,
I'm gonna
thank
stop.
you.
I'm gonna stop right here.
Uh-huh.
I'm not gonna torture you more today.
No, please.
And yes, and next week we're gonna have another
Okay. Okay.
session. Let's do it
Okay.
that way
Okay. Thank
rather
you.
than rushing through the chapters.
Okay. See you next week.
See you next week,
Oh, yeah.
guys.
Okay. Thank you. Bye.